Welcome back to The Note. Pension plans face a crisis, and you can feel it right here on the streets of New York City. The city's workers, such as these firefighters, rely on defined benefit pension plans for their retirement. But it's getting ever harder for New York and many other cities and states across the country to meet those promises. That's partly because people are living longer, of course, but the biggest cause of pain for pension managers: falling bond yields. When people retire, you fund your guarantees to them by buying bonds. Lower yields mean you have to buy more bonds to back up those promises. And equities are expensive, so you can't rely on growth there to help catch up. 3 decades ago, public pension funds were in surplus. Since then, their liabilities, the cost of their promises, have grown far faster than their assets. That leaves them facing deficits. Short of bankruptcy, they can't get out of those promises. So what can they do? Here in New York, former Mayor Mike Bloomberg thought Canada had the answer. Canada reformed its public pension funds a quarter of a decade ago, and they make great returns. They give their funds independence, they let them pay high salaries to people to manage investments in-house without paying fees to outsiders, and they think long-term, putting money in illiquid assets, not just expensive stocks and bonds. That means financing lotteries, lending to small companies, and building infrastructure. Canadian pension plans are building wind farms, rapid transit lines and toll roads across the world, and they own a lot of real estate, including Stuyvesant Town here in New York. They also leverage up at low rates. Mayor Bloomberg wanted to do that here. He wanted to put New York City's 5 separate pension funds into one and give them more independence. That plan seems to be on the indefinite back burner. It's very political. But the city is confronting some serious problems. Politicians don't want to pay high salaries to manage funds in-house. So instead you get this. The list of companies to whom New York paid investment management fees last year runs to 9 pages. They received $183 million. But past accounts were so poor that they don't know what their returns over the last 10 years have been after fees. Dig through their accounts and you find 2 asterisks against their long-term returns to say they're quoted gross of those very big fees. When New York City Controller Scott Stringer reported on this issue last year, he found that the city's pension plans were $2.5 billion behind a reasonable benchmark for the last 10 years once you took fees into account. But that's only an estimate because the historic data doesn't have returns net of fees for public investments. Mr. Stringer is rethinking that model. Saving fees is good, but it doesn't help invest in productive assets like the Canadian plans do. And you still have the problem that New York is somehow going to have to generate higher returns to meet its promises to these firefighters and others without taking too much risk. That's difficult. Now, pension plans can ultimately make the long-term investments that this country badly needs. There is an opportunity here, but the capital of capitalism is going to have to learn the lessons from Canada.